Hello, are you studying for your state property casualty insurance test, either general lines or personal lines? Are you learning about the important terms replacement value, actual cash value, agreed value, what we call loss valuation? Well, we're going to cover those important terms on today's video, and be sure to stick around to the end where we're going to cover a practice question to get you ready to pass that test. Let's go ahead and get started. Welcome back. Now, we're going to cover these important terms, what we call the loss valuation, replacement value, actual cash value, and agreed value. Now, that kind of goes along with the other video that we have on what's called cause of loss forms. I'll reference it right up there, or you can see a link in the description below. Be sure to take a look at that one, because these two videos, this one and the one on the cause of loss forms, are really fundamental for you understanding how to pass that test and understand the different policies. When we get into the different policies, and we'll cover those in a future video, we talk about each of these in terms of how the cause of loss form works and how the loss valuation works. And if you understand those terms, then it's going to be really easy to understand how each of the individual policies work. Now let's go ahead and jump into it. Now let's start with the concept of what is real property, building or dwelling, and what is content. The reason that we have to understand those is because the policies make a clear distinction in how these items are covered. The building is typically covered on replacement, whereas your personal property or content is covered on actual cash value, which we'll get into in just a moment. So what's the difference between real property and personal property? Well, let's say you take your house, pick it up, you tear the roof off, and you turn it upside down and give it a good shake. Well, whatever falls out would be personal property, contents, and whatever doesn't fall out would be real property, building or dwelling. And as we said, the policy makes a real distinction between which one of those it is and how it's handled. Now, in the real world, it's really not just what falls out. It's really basically this. Suppose you move into a brand new house. Think new construction house. What's going to be in there already? Well, the wall-to-wall carpeting, the curtains or draperies that are attached to the wall, the appliances would be there. And a reason I had to make that distinction is because a lot of us was thinking, well, we turn our house upside down, the refrigerator is going to fall out. Well, typically your appliances are going to count as dwelling, not content. Now, on the other hand, policies tend to be a little old-fashioned. So these days, most times people have their TVs attached to the wall, flat screen, right? Well, the policies are thinking about them old big TVs that are consoles that would fall out. So TVs, even if they are attached, are always considered to be personal property, and appliances, typically, even though they might fall out, are generally considered to be dwelling or the real estate, the real property. Got the difference? All right. Let's talk about a little more detail here. So as I said, the building or dwelling or the contents are handled differently. It points out that not all personal property can be covered under a homeowner's policy. For example, automobiles are only insurable under an auto policy. The real property is the things that are attached: windows, doors, sinks, toilets, etc., wall-to-wall carpeting, that sort of thing. And the contents are things that are not attached. Now we have a definition here, which is the definition of a direct loss versus an indirect loss. Now what's the difference? A direct loss is something that was caused directly by a covered peril. An indirect loss is something that is a consequence of that covered peril. For example, having to stay in a hotel room because your house burned down. Having to rent a replacement car because your car is damaged and in the shop. We also sometimes think of indirect loss as things like food that spoils because a refrigeration system is out of operation. Now let's talk about loss valuation, or how the value is measured. Now this is a very important component, as we've already talked about, in understanding these policies. There are 5 loss valuation methods, but you'll notice from my slide here that I only have 3 of them in bold. Now, that's because only those 3 in bold really show up on the test. I'm going to cover all 5 just in case, because you never know what they'll throw at you. But those 3 main ones that are in bold, those are the ones you really want to know. So let's start with replacement cost. What is replacement cost? Well, replacement cost means they're going to give you a brand new one, or they're going to build you a brand new one. So if it would cost $400,000 a day to build you a new house, just like your original house, then that's what the insurance company is going to do. They're going to buy or build you a new one. In other words, replacement means exactly what it says. They're going to replace it, even if it costs more today than what you originally had when you got it. Now, I do want to point out that they're not going to build you a better house. So if you owned a 3-bedroom, 2-bath house before, when the house burns down, they're not going to build you a 4-bedroom, 3-bath house. That would be better. They're going to buy or build you something equivalent to what you had previously, not better. But you do get a brand new one, or they're going to build you a brand new one. Let's take a look at a question that anchors a very important concept here, and let's see if you can pick up on this subtle little concept. Here's the question. 20 years ago, Eldon paid a contractor $100,000 to build a house on land that is worth $50,000. Today, the land is worth $75,000, and it would cost $250,000 to build the same kind of house. What is the current replacement cost value of Eldon's house? Well, the thing is, if the house burns down, you don't have to replace the property. The property is still there. So we only replace the what? We only replace the building. The land does not count. Now, a lot of people get thrown off by this because they look at their homeowner's policy and they say, well, I paid X for my property, so that must be what my replacement cost is. Or I look on Zillow and this is what it says my house is worth today. That's not your replacement cost. Your replacement cost is how much would it cost to build you the new house, and we're not including the cost of the land in that. That's an important point to understand when we're talking about replacement. Now let's go on to functional replacement cost. With functional replacement cost, what we have here is a house that is older, an antique, or a Victorian home. Well, we cannot build you a new antique. So we're going to build you something that is functionally equivalent. In other words, if it was a 3-bedroom, 2-bath house before, then you're going to get a 3-bedroom, 2-bath house now, only it'll be built with modern building methods. Now, this next one is probably the most important of the 3 main ones, and that is actual cash value. Actual cash value is defined as replacement cost minus physical depreciation. Now, when we do our live classes, I make my students repeat that out loud. Replacement cost minus physical depreciation, because on the state test, that's exactly how it's worded. What is the definition of actual cash value? Replacement cost minus physical depreciation. An important point to note here is that the original purchase price is not important. Now realize that when you have a question that has 4 answers, they've got to be some information in there so they can come up with the other wrong answers. One of the wrong answers is going to be something to do with the item's purchase price or the original price. My slide here says a household object that would cost $1,000 10 years ago has depreciated in value. It may have an actual cash value of only $400 today, which means what? What you originally paid for that item 10 years ago means nothing for nothing. So on a question on the test, remember that what? The purchase price or the original price is not important. Now this next one, and honestly, we don't see this one on the test very much, is called stated amount. The stated amount would be the what? The stated amount would be the most amount that the insurance company would pay, because they're going to pay the what? The lowest of the actual cash value, the cost to repair or replace, or the amount that is stated in the policy. They're always going to try to pay the lowest amount, as you probably already know if you've dealt with an insurance company. Then we have agreed value. Although we don't see stated value on the test very much, you do see agreed value. That comes up on the test quite often. And this is one of the important points of a policy, is that you can get a specific amount of coverage if you so desire for certain types of objects. Artwork, one-of-a-kind items, antiques, stamp collections, coin collections. These items are very difficult for the insurance company to value. To an insurance company, an antique quarter that you think is worth thousands of dollars is worth 25 cents to them. So if you want to get the value that you believe that it is, you need to have it set up on what's called agreed value. Now, you can't just come up with any old value. It has to have some sort of underlying reason. For example, an art appraisal or a competitive sale of an item that is very similar. But if you can come up with that value that you can justify, then you and the insurance company agree on the value. Were there to be a loss, the agreed value is what the insurance company would pay. Let's take a look at a question and see how a question on these loss valuations might show up on the test. The question says, John's couch is destroyed in a fire. John originally paid $1,000 for the couch. A similar new couch today costs $1,200. The insurer assigns the couch $400 of depreciation. Now, as you probably already learned, or if you haven't, when you look at homeowners policy, you'll know that contents are generally valued as actual cash value. And in John's homeowners policy, that's probably how the couch is valued, at actual cash value. Remember that under actual cash value, you get what? It's replacement minus depreciation, which means the original amount that John paid for the couch means nothing here. The couch, to replace it, would cost what? $1,200. We have to take off $400 depreciation. So our correct answer here is $800. Now remember, this is a typical question you might find on the test, and that actual cash value, the original price you paid, means nothing. That's an important point to remember. So I hope this helped you guys. Please give us a like if you felt this was a valuable thing for you. Remember that we would love for you to subscribe and hit that notification bell so you'll know when we have new videos coming out. Make sure that you take a look at our website, mortonschools.com. There we have classes for any state in the union. We have pre-licensing and continuing education classes for property casualty, for life and health, in some states adjusters, and we have securities classes as well. Thank you very much for joining us, and we'll see you on the next one.